You know that old saying, right? Nothing is certain except death and taxes. Well, today we're talking about the exact spot where those two certainties intersect. IRS Form 706, the U.S. estate tax return. But listen, this isn't just another tax form to get bogged down in. I like to think of it as the final financial statement of a person's life, a complete accounting of everything they worked for and built.
Okay, so how are we going to break this down? We're going to follow a really clear journey. First, we'll get a handle on what this final statement really is. Then, we'll tackle the big one, what I call the $13.6 million question, to see who this actually even applies to. After that, we'll uncover what is basically a financial superpower for surviving spouses. We'll look at a few powerful choices an executor can make. And finally, we'll get down to the brass tacks of paying the final bill.
So first things first, what is the estate tax? And here's the key thing you've got to know. It's a tax on the entire taxable estate of the person who passed away. This is not, I repeat, not an inheritance tax. An inheritance tax is paid by the people who receive the money. With the estate tax, the estate itself pays the bill before a single dollar goes out to the beneficiaries.
And that, of course, brings us to the question that's probably on your mind right now. Who actually needs to worry about filing this thing?
Well, for anyone who passed away in 2024, the answer really boils down to one very, very big number.
And here it is, $13,610,000. That is the basic exclusion amount for 2024. And this is absolutely crucial. If a person's total gross estate is less than this number, you generally will not owe a dime in federal estate tax. This means the vast majority of estates in the U.S. are completely off the hook.
And this is where it gets really interesting. There are two main reasons you'd file a Form 706. Path number one is pretty simple. You have to, because the estate is over that $13.61 million mark. But path number two is completely different. It's strategic. You file even if the estate is way below the limit, and it might just be one of the smartest financial moves you can make for a surviving spouse.
This strategic move is called portability. And honestly, for many families, this could be the single most important thing you take away from our chat today. Think of it like a financial superpower you can hand off to a surviving spouse, and it all boils down to a funny-sounding acronym, DSUE.
DSUE. Yeah, I know, it stands for Deceased Spousal Unused Exclusion. Total mouthful, right? But the idea behind it is actually incredibly simple and powerful. It's basically a rule in the tax code that says whatever part of that $13.61 million exclusion a deceased spouse didn't use can be transferred over to the surviving spouse. It's not lost, it's portable.
Let's just walk through a quick example. Let's say spouse A passes away with an estate worth about $3.61 million. Okay, so they've used up that much of their exclusion, but that leaves a whole $10 million unused. The executor then files Form 706, even though zero tax is due, specifically to elect portability. Now, spouse B's future estate is protected by their own exclusion plus that unused $10 million from spouse A. It essentially doubles their protection down the road. It's a huge deal.
Now, portability is a huge strategic tool, but it's not the only one. Form 706 gives an executor some other really powerful choices to help minimize the tax bill. These are a little more advanced, but they're fascinating because they show how flexible the tax code can actually be.
First up is the alternate valuation election. Just imagine an estate's main asset is a big portfolio of stocks, and a few months after the owner passes away, the market just tanks. Well, this election lets the executor choose to value all the assets 6 months after the date of death instead. If the value has dropped, the tax bill drops right along with it. It's like a built-in safety net against market swings. Then you've got something called special use valuation. Now, this is a highly specific, but for the right family, an incredibly valuable tool. It's designed for family farms and closely held businesses. Instead of valuing the land at its highest and best use, like, say, what it would be worth to a developer building a shopping mall, it can be valued based on its actual use as a farm. Of course, the requirements are really strict, but that's to make sure it's doing what it's supposed to do, helping keep family businesses in the family. All right, we've figured out what the estate is worth, we've made our strategic elections, now it's time to handle the logistics. This section is all about the practical, real-world stuff. When to file, how to pay, and what happens if you get things wrong.
So the deadline is firm, and it's a really important one to circle on the calendar. The clock starts ticking on the date of death, and the executor has exactly 9 months to file that Form 706 and pay any tax that's due. You can get an extension to file, but you can't get an extension to pay. And now for one of my favorite little details.
buried deep inside the IRS instructions. If you ever find yourself in a position where you need to pay an estate tax of, let's say, $100 million or more, you can't just write one giant check. Seriously, the IRS won't accept it. You actually have to spread the payment over 2 or more checks. It's just a wild rule for a problem I think most of us would be okay with having.
On a more serious note, though, the IRS does not mess around when it comes to getting valuations right. The penalties for understating the value of assets are steep. If you report an asset's value at 65% or less of what it's actually worth, you're looking at a 20% penalty on the tax you underpaid. And if it's a gross understatement, 40% or less, that penalty doubles to 40%. The message here is crystal clear. Good, accurate appraisals are non-negotiable.
You know, we've spent all this time breaking down the numbers and the rules and the strategies of Form 706. But as we finish up, it's worth just zooming out for a second. This form, at its heart, is the final accounting of a financial life. And it kind of forces us to ask, beyond the assets and all the tax calculations, what's the story we want our numbers to tell? What does a legacy truly mean?